Hi, thanks so much for joining in. You're watching BQ Prime. My name is Alex Mathew. Now, when things are as uncertain as they are right now, and there are as many moving parts as they are right now, then one of the most important things that you can look for as an investor is perspective. And to get perspective from people that have been in the industry and have seen market cycles is perhaps the most important thing. And so, with that in mind, I have to introduce my guest today. Rushabh, Rushabh Sheth of Karma Capital. Thank you so much, Rushabh, for taking the time. And it's not very often that we get to speak to you, so thank you so much for taking that.
No, thanks so much, Alex, for having me here.
So let me start by asking you, it's very hard to predict the outcome of all of these moving parts and where they will land, whether it's geopolitics, whether it's the price of oil, whether it is monetary policy in the US. I think even the central banks have gone wrong in their predictions. So as an investor or as a CIO, when you're looking at all of these moving parts, what are you focusing on?
No, I think we keep it simple in terms of what we are looking for in our investment thesis. We are very clear that we can only choose the team which kind of can navigate through all this. From our perspective, uh, having seen this for 30 years, we know that this is going to be a constant. Change is a constant. Things will keep happening in the environment. Narratives change. Last year was high commodity prices. This year, it's a different narrative. Of course, higher interest rates is something in the at least the developed world, which maybe a generation of people have not seen. So my sense is, from our perspective, we keep it simple. We try and ensure that we are focusing on companies where we understand the businesses, where the underlying managements are continuing to execute on the ground well, and that to us is very important because at the end of the day, India is a growth market, and if businesses are growing and continuing to execute well, you will get your share of the returns.
So if the thesis hasn't changed,
Yeah.
The one thing I think that could have changed over the last 3 years is valuations, right? So
Yeah.
while the set of companies and the set of managements that you like hasn't changed, valuations certainly have.
Absolutely.
Are they at a difficult level to look at right now?
From our perspective, you're absolutely right. I think what has happened in the last 3 years post-COVID has been a significant change in terms of valuation of especially the small companies. In fact, our biggest concern is the smallest companies rather than the bigger companies. And we've seen the biggest delta happen because a lot of retail and even money flow into mutual fund has gone into these businesses. So from our perspective, that's where maybe a caution is warranted. Um, as investors, from our portfolio perspective, we are looking at 20, 25 names. For us to be able to identify those names at a reasonable price, even in a market like currently we are seeing, is not very challenging because we are maybe adding 4 or 5 names a year. And therefore, from our focus is more on looking at that few businesses where we can find value. And of course, we can find all the other parameters that we look at. But you're absolutely right. The valuation, especially on the small and mid cap, and the smaller the business, actually the valuation has seen the biggest amount of delta, and that's where maybe a little bit of a concern to us happens.
So let me understand this correctly. Around 25 stocks that you have consistently in your portfolio, and you change 4 or 5 of them every year.
Yeah.
Does the churn increase based on the scenario that you are in, and you anticipate, because valuations may be a little bit stretched in some of these names, that you will have to churn more?
Good question. We don't see it like that. From our perspective, we are very bottom up. We will buy based on our merit in each of the names that we own. Yes, sometimes the churn does rise because you kind of have reached a point in many of the companies where the valuations have reached where you want to sell and get out. And sometimes you don't find the names correspondingly in this kind of environment which you can add. So you might want to wait a little while. So maybe, but that doesn't really increase the churn too much. But yes, it does increase it a little bit.
So what I was trying to get at, or what I was trying to glean from that, is how much dry powder do you keep if you anticipate, on the one hand, that, and laying all of it out, on the one hand you have valuations that are a little stretched, on the other hand, therefore, you don't have too many stocks that are looking attractive at this juncture. You might want to sell and get out, but you can't deploy immediately. So how much do you sit on? Can you sit on cash?
Very good question. So from our perspective, there are two parts to it. One is existing portfolios. Because we do manage money for large offshore institutions, there is a mandate to not keep beyond a certain level of cash.
Sure.
Whereas if there is a new investor who's coming in, we don't have a model portfolio approach, so we typically take 2 to 3 months to deploy. So that's the time that we get, and we are not really compelled to invest immediately. So in this kind of a market, we would typically use up that 2 or 3 months for newer portfolios which come to us today. On the older portfolios, we are restricted to certain amount of cash, because at the end of the day, these investors are taking a call that we want to remain invested in equities. So we are not really taking a cash call for them. But you, of course, position the portfolio to ensure that you hopefully navigate through a more turbulent patch in the markets.
I would think that because of the approach that you have, you're sector agnostic and market cap agnostic, you look for value where you get it.
Right.
What is the tone and tenor of your portfolio right now, without maybe getting into individual names? How does it stand?
So typically, if you look at our average holding periods of 5 years, so once we buy into a name, we own it for about 5 years. We have a reasonably high hit rate. So typically, we don't, or we make money on maybe 90% of the names we buy into.
Okay.
And therefore, then you can imagine that we are not the guys who would get too perturbed about maybe change in the environment and all that, and that's not really impacting our investments. Of course, we are constantly looking at and reevaluating all our existing positions, because sometimes things do change in the businesses. So you kind of you want to be agile on where there is a change. But by and large, we don't see too much of a churn in the portfolio, because the environment sometimes changes, and maybe sometimes changes adversely.
Okay. The vintage then of the stocks that you're holding right now are by and large close to that 5 mark?
Yeah, absolutely. So there are, of course, companies that we have bought over the last 3-4 years, which will be shorter in terms of, and then there will be companies which we own for 8-9 years. So there's a mix of them. I would think that on an average, it would be about 4 to 5 years still, for all the companies that we have. So the way we look at it is that once we buy into a name, and typically we size up positions, we start small on every position that we kind of buy, and then we kind of also sell gradually over time. So typically there is a building up period and then there's a selling period, and that's why maybe you have a slightly longer tenure.
How do you decide when to sell?
That's a good question. I think the easiest is if you've gone wrong. Then that's the easiest call to make. The more difficult call is the valuation call, saying that look, valuations have reached a point where maybe it doesn't maybe justify for us to kind of hold it. But that's a call which is always going to be a little bit gray, because typically if you've gone right on your investment thesis, the stocks generally overshoot your valuation. So when you're buying with a certain view in mind, and if you've gone right on your hypothesis, generally the valuations also overshoot what you think is the fair price for it. But yeah, at somewhere you have to take a call that look, now it doesn't make sense for me, and we will get out of it.
Okay. Would you say that there's considerable amount of froth in the system right now?
I think the froth is a very difficult word to kind of explain right now. But my sense is, as I said, we see the maximum level of optimism in the smaller companies. We don't see that kind of valuation stretch on the bigger names. Of course, the bigger names, some of them are also expensive. But I think if you take relatively, I think the bigger concern is in the smaller names, and where there is also a significantly higher exposure to the environment. The bigger names can take the change in the environment in their stride, because they've kind of seen the cycles, they've navigated through it. The smaller companies will find it that much more challenging, and that's quite visible. If you look at the numbers coming out in the second quarter numbers this time, the volume growth across a lot of companies or businesses is slowed down considerably. And I think that challenge is what is visible already on ground. And that, according to us, is not going to change, because we are going to run into an election in the next 6 months. So there's some amount of uncertainty which is going to remain in the environment.
So I was kind of going to come to earnings, because you're always trying to justify valuations where they stand right now and try to project going forward, saying that it's completely fine, despite the fact that we've outperformed several peer markets and we've not fallen as much as the US markets. Earnings are great, visibility is great, India is a bright spot. All of that is ticked all of the boxes. But the question is, you've got 60,000 plus crore of rupees that have flowed into mid cap and small cap funds, and fund managers are finding it hard to to find where to put. They're holding a significant amount of cash. What is the straw that breaks the camel's back, if you can look for that? Because at some point, something's got to give.
Yeah, I think we saw a glimpse of it last week, when the markets kind of reacted to various news. And our sense is that we really don't know.
Yeah.
It's very difficult to project what will be that straw which will kind of break the camel's back. But as investors, we can always be cautious and say, that, look, we know that this is a concern in the market, and therefore you kind of need to navigate around it. And that, I think, is very important. And I think that having seen cycles, you kind of maybe understood, hopefully, the fact that maybe you can now navigate that cycle better because you are already anticipating that something like this will happen. Timing of this is never given.
So, but between and this is kind of coming to the culmination of our conversation, but between 3 years back, say after the COVID crash, where you were probably standing on the rooftops and screaming to your clients saying, look, you got to deploy funds, you got to invest right now, these are the levels, to now, where you're saying perhaps it's better for you to bide your time. You're saying 3 months, you're utilizing the entire time frame to deploy funds. Do you anticipate that this will change anytime soon, or do you think this will be the status quo heading into the new year, elections and all of that?
I think there is a lot of uncertainty in the environment, as you rightly pointed out, both locally and globally. I don't think so. This certain uncertainty is going to go away. At least locally, we are going to keep having that uncertainty till the elections, which is still at least 6, 7 months away. And from our perspective, the global uncertainties just got worse in October as we speak. So my sense is that this environment is not really, and I think now there's a thought seeping into people's mind that the interest rates might remain higher for longer.
Yes.
And that, I think, that kind of environment, we don't think so is going to change in a hurry unless something breaks somewhere and the central banks are forced to act to kind of, exactly. So my sense is that at least for the next few quarters, we think that the environment is going to remain a little bit challenging, and we will all have to navigate around it.
So last question, and I think a lot of my viewers will watch the answer to this question very carefully as well, because you kind of alluded to the fact that you're seeing signs of slowing down in terms of volumes, a few of the companies that you've been looking at. Where do you still see potential? Where do you still see opportunities?
So look, I don't want to get into names.
No,
by and large, we really believe that there is, domestic opportunity in India is structural in nature. And we think that this is not going to go away. This is not going to change with 2 quarters. So, for example, for us, healthcare is our largest holding right now. And we believe that as India progresses from $2,200 to $5,000 per capita, I think one of the biggest deltas in consumer discretionary spend is actually going to be healthcare. As people take better care of themselves and, they spend more money. And I'm just giving you as a flavor of where we think that there is still a lot of opportunity. The valuations are not that demanding in the sector, and the companies are executing very well. And this is not a business where you can throw $5 or $10 billion and build a business overnight. So this is a challenging business, very granular in nature, built over time, available at a reasonable price, and with a long-term structural driver in place. So from our perspective, those are the kind of businesses that we are looking at.
So formulations or the final healthcare, where you're talking about hospitals, etc.
I think opportunities across the board.
Sure.
Of course, our largest exposure is pharma companies today. But my sense is across the healthcare value chain, you will get opportunities. And that business is still very fragmented. If you look at the largest companies, they still have maybe 10% or so market share. So that consolidation is going to continue in that sector for many, many years. And that will continue to drive the bigger, better companies to, exactly what happened in maybe FMCG 10 years back will happen in pharma over the next maybe 5 to 10 years.
Fantastic. I think hopefully my viewers have gotten some sense of the thinking that you are currently espousing when you're looking at your investments. Thank you so much.
Thank you so much for having me, Alex. Very nice to talk to you. Yeah.
Viewers, there you have it. Do stay tuned. Lots more coming up on VQ.